Vetiva Capital Management, their research division, is bullish on Sub-Saharan African banks in 2024. In the new report, they say that core banking will drive growth next year. There it is. Yes, core banking for full year 2024 SSA banking outlook. They're saying it is going to drive growth. So joining us now to jump in, Olumide Shole, who's a Sub-Saharan banking research analyst at Vetiva Capital Management. Olumide, it's good to see you. Good morning to you. Thanks for joining us. So your report talks, I love this stuff. Your report talks about tailwinds for the banking sector. I think FX and revaluation gains and interest rates. So explain it to the viewers.
So basically, for 2023, we saw that majority of our coverage banks recorded massive jump in their earnings. Like we saw about triple-digit growth in the bottom line, majorly driven by FX evaluation gains. We saw the likes of Zenith, UBA, GTCO record a material FX evaluation gain to the tune of close to about 300 billion for each of these banks. So as a result of that, we saw a massive jump in their bottom line. Yeah. We also saw improvement in their interest income, their core banking income, which was majorly driven by the tightening we're currently experiencing.
So higher interest
rates regime by the central banks, so as to be able to curtail inflationary pressure. So as a result of that, we saw this trickle down to the bottom line of our banks.
Okay, but your procedure, I love this. You guys, you're giving us both sides here. The flip side of the higher interest rates is cost of funds, right? So to talk about that, because I think you got a chart and some other things on the rising cost of funds for the banks.
So for cost of funds, we see that as interest rates continue to go up, we also see cost of funds also rising for majority of our coverage banks, majorly on the back of as interest rates rises, that means banks have to pay more for pay more interest rate for their customer deposit. Also, we also noticed that banks with larger proportion of their deposit in time deposit were experiencing the larger increase in their interest expense. Yeah. That is, for instance, now let's say a bank has 40% of the deposit in time deposit, another bank has 30% in time deposit. So the bank with 40% will likely experience more increase in interest expense. Yeah. So we expect this to continue even into 2024.
Talk to us about the SDF window. I think explain that, because there was a cap, they took off the cap, and you're saying that's going to benefit banks in some way. So can you explain what it?
So for the SDF window, which is just majorly the standing deposit facility, we saw that the CBN removed the 2 billion cap, which does the limit of amount that the banks can deposit daily via that window. It has been removed, so it's now that the banks can deposit more than 2 billion naira daily via that window, and this gives banks ample chance or more earning potentials for their revenue or their core banking income to grow better. And compared to for instance, if a bank can just deposit 2 billion there, that means the other excess liquidity they have to find a way to
earn something on it.
To earn something on it.
Yeah.
And they will not be able to earn at the SDF window, which is around 15.75%. And they will likely be earning lower than that. But now, since they can deposit everything via that window, they will definitely be earning 17.5% on all their deposits.
We just had it. Let me put that chart back up. The treasury bills, there was also an impact on T-bills, where T-bills rates were rising. So explain the trigger for that?
Yeah, so for the T-bills, we saw that majorly, as banks can now earn more via that window, it's like an opportunity cost. Since they can earn 15.75% via that window, it will make sense for them to be earning something lower than that via the T-bill, what the T-bill is offering. Yeah. For instance, sometime early this year, we saw that even as interest rate was around 18.5%, 18.75%, but that's the MPR. We're still seeing T-bills trading at single-digit interest rates, right, which was not very, very encouraging. It's not in line with economic realities. Right. So now that banks cannot deposit their excess liquidity via that window, the opportunity cost is now better. That is since they can get more there, why would they want to put their money on something that will pay in single digits. So as a result of that, we're not seeing the rate go up, going up.
Well, that's good. All right, this is my favorite part: banking calls, because we talk a lot about stocks. So you guys have your banking coverage. You've got some stocks. Let's see how quickly we can get through all these banks. Access Holdings, we'll go alphabetically. You have a buy rating on the stock. In fact, when this report was published, the stock was at 17 naira, but as of Friday, it closed at. In fact, you nailed it. So I don't know if this is just a coincidence, but your target price was 22 naira 20, and that is exactly where it closed on Friday. So what's your outlook for Access as far as the buy rating?
So we expect the earnings of Access continue to grow. Access has continued to be like it is now the largest bank as per asset size. The balance sheet size of the bank is maybe the largest bank in Nigeria currently. As the bank continues to continue its acquisition strategy, we've seen the bank acquire Standard Chartered and even move into Hong Kong currently. So we expect this to continue to drive good for the bank. Majorly now, the bank price has hit our target price, majorly because of market activity, and we expect, but fundamentally the stock is still very, very strong. All
right, now you have a sell on FBN Holdings, and this is a stock that just joined the trillion naira market cap. Yeah. When you published it, I think it was at 25 naira, so now it's at 23.20. I think that's where it closed. Why the sell for FBN?
So FBN has rallied significantly this year, and even especially this Q4. We've seen the stock rally. Majorly, it's majorly number one. The performance of the bank has been good this year. Also, the corporate action the bank is currently facing. We saw that the bank is trying to commence its rights issue. Also issuing some shares in the stock market. So the contribution of this, we'll see the trying to create new shares is kind of dilutive for the shareholders' price. That is, they'll be creating more shares. So definitely, we see that it has been diluted, and also even these more shares will also help the bank to expand its activity. So it's just more of market activities and more like.
All right, still on the alphabetical. Next up, FCNB Group. You have a buy rating on FCNB. Well, that's in the tier 2 space. What's the justification for FCNB?
So FCNB has done very good this year, and we expect the bank to continue to do very well. And the bank just completed its AT1 capital, that's additional tier 1 capital issuance, and we expect this to improve the bank capital adequacy ratio. That is, the bank is now well positioned to absorb more risks and even take out more loan, give out more loan, expand its loan book, and also expand its banking operations, which definitely is bullish for the bank. So we definitely see this improving the bank performance into the future.
I really do love asset management on the equity side. All right, next up, I'm having so much fun with this. Fidelity Bank. You also have a buy on Fidelity. So what's the trigger for Fidelity?
So Fidelity has been doing quite well. The bank net interest margin has the bank among its peers, it recorded the largest or the most significant expansion in net interest margin, and we expect this to continue to drive growth for the bank. Also, the bank has also embarked on some acquisition strategy. We saw the bank acquire Union Bank UK, and we expect this to also improve the bank balance sheet, and also which will also trickle into the earnings of the bank coming in next year. So definitely, that's why we give the stock a rating.
All right, back to tier 1. GTCO, they closed 39.90 on Friday. So far this year, the bank is up 71%. You have a buy rating on GT. Or what's the trigger for that?
So GT among its banking peers has one of the highest payout ratio, dividend payout ratio.
Shareholders will love that.
Shareholders love that. So definitely, we see this playing out even into next year. And so we expect the bank to even maintain its 50% payout ratio by the end of this year and even continue to next year. So definitely, the dividend payout of the bank will be very, very, very massive and definitely help to make the rally the stock even into the future.
We're doing well. We got about 3 minutes to go and 3 more banks. Okay, Stanbic, you have a hold on Stanbic. So explain that? Because I think they're about now almost 100% up, 97% year-to-date return. What's the reason for the hold for Stanbic?
So Stanbic has been doing quite impressive. The performance has been quite impressive. They have even launched a fintech subsidiary. But my major concern is their dividend payout. We saw that their interim dividend was at 1.5 naira, which was even the same with what they paid last year. So it kind of signifies that the bank might not, this dividend payout might not be in line with investors' expectation. That's the growth in dividend payout might not be in line with dividend investors' expectation. So as a result of that, we're a bit cautious in our rating of Stanbic. All
right. Next up, UBA. Again, just to remind our viewers, these are banks in your coverage that you guys follow, right? Cool. UBA, you have a buy rating on UBA. What is the what's the call for UBA?
So UBA definitely, the bank has also recorded impressive performance this year. And we expect this to even continue to 2024. We expect this to continue. The bank also recorded one of the largest net interest margin, and we expect this to support the bank performance into 2024. And also the commission and fees income of the bank also recorded impressive growth, and we expect this to even continue next year. So basically, that's majorly one of our reasons.
You're doing excellent on time. We've got our final bank with a minute to go. Zenith. So we round up with Zenith. You also have a buy rating on Zenith. What's the trigger there for Zenith?
So besides GT, that has largest one of the largest dividend payouts. Zenith also has like the second with like about 40% dividend payout on average. So definitely this is very, very impressive for investors. And the bank is even has been the most profitable bank before 2023. So we expect this to continue to support the bank performance in the stock market and even to 2024.
Olumide, surely that was a lot of fun. I could do this for 1 hour. I just love talking with you. This is how wealth is built. Sub-Saharan banking, Africa banking analyst with Vetiva Capital Management Research Group. Olumide, surely thank you so much for your time. Appreciate it. And great report. You guys keep up those reports. We love reading them.